In the world of business, knowledge is power, and when it comes to money, that knowledge comes from accounting and finance. These two fields are the backbone of every successful business. They tell you where your money is, where it's going, and how to make it grow. Without them, you're flying blind. Accounting is like keeping score. It tracks every dollar that comes in and goes out. It gives you a clear picture of your financial health. Finance, on the other hand, is about making smart decisions with your money. It's about planning for the future and making investments that will grow your wealth. Stakeholders are everyone who has a vested interest in the business. This includes investors, employees, customers, and even the community. They all rely on accurate financial information to make informed decisions. Strong accounting and finance practices build trust and confidence. Without accounting and finance, businesses are set up for failure. It's not just about numbers, it's about understanding the story behind those numbers. That's how you make smart decisions and achieve lasting success. In the world of business, it's easy to think that the only thing that matters is the bottom line. But the truth is, there are a lot of people who care about a company's financial well-being. We call these people stakeholders. Stakeholders are anyone who has a vested interest in the success of a business. This includes investors, of course, who are looking for a return on their investment. But it also includes employees, who rely on the company for their livelihoods. And let's not forget the customers, who depend on the company for its products or services. Even the community where a business operates is a stakeholder. They benefit from the jobs and economic activity the company creates. Each stakeholder group has its own unique interests and concerns. Investors want to see profits and growth. Employees want job security and fair wages. Customers want quality products and services at reasonable prices. Understanding the needs of all stakeholders is crucial for long-term success. When businesses prioritize their stakeholders, everyone benefits. Accounting is often called the language of business, but just like any language, it has different dialects. Two of the most important are managerial accounting and financial accounting. Think of them as two sides of the same coin. Managerial accounting is like looking in the mirror. It's for internal use, helping managers make decisions about the business. This type of accounting provides detailed information on costs, budgets, and performance metrics. It's about looking at the past to make better decisions for the future. Financial accounting, on the other hand, is like sending a postcard. It communicates financial information to the outside world. This includes investors, creditors, and government agencies. Financial accounting follows strict rules and regulations to ensure accuracy and transparency. While both types of accounting deal with financial data, their purposes and audiences are different. Managerial accounting is about making the business run better. Financial accounting is about showing the world how the business is doing. Imagine playing a game without any rules. It would be chaotic, right? The same is true in accounting. Without a common set of rules, financial statements would be meaningless. That's where GAAP comes in. GAAP stands for Generally Accepted Accounting Principles. These are the rules and guidelines that businesses in the United States must follow when preparing financial statements. Think of GAAP as the rule book for accounting. It ensures that financial statements are consistent, comparable, and transparent. Why is GAAP so important? For starters, it allows investors to compare the financial health of different companies. It also helps creditors assess the risk of lending money. Without GAAP, financial statements would be open to interpretation and manipulation. GAAP might seem complicated, but it serves a vital purpose. It levels the playing field and promotes trust and integrity in financial reporting. Section 5. The Financial Snapshot, Income Statements, and Balance Sheets Explained. In the business world, you need a way to track your progress and see where you stand financially. That's where income statements and balance sheets come in. These two essential financial statements are like snapshots of your business at a specific point in time. The income statement, also known as the profit and loss statement, tells you how much money your business made or lost over a period of time. It lists your revenues, expenses, and net income. Think of it as a movie of your business's financial performance. The balance sheet, on the other hand, provides a snapshot of your assets, liabilities, and equity at a specific moment. Assets are what your business owns, like cash, equipment, and inventory. Liabilities are what you owe to others, such as loans and accounts payable. Equity represents the owner's stake in the business. Together, the income statement and balance sheet give you a complete picture of your business's financial health. They help you track your progress, identify areas for improvement, and make informed decisions about the future. Section 6. Beyond the snapshot, cash flow and equity statements. While income statements and balance sheets provide valuable insights, they don't tell the whole story. To get a complete understanding of your business's financial health, you also need to consider cash flow and equity statements. The cash flow statement tracks the movement of cash both in and out of your business over a period of time. It shows you where your cash is coming from and where it's going. This is crucial information for managing your liquidity and ensuring you can meet your financial obligations. The equity statement, also known as the Statement of Retained Earnings, shows how your business's equity has changed over time. It tracks your profits, losses, and any dividends paid to shareholders. This statement provides valuable insights into your business's long-term financial stability and growth. By analyzing your cash flow and equity statements, you can identify trends, anticipate potential problems, and make strategic decisions to strengthen your financial position. These statements provide a dynamic view of your finances, complementing the static snapshots offered by income statements and balance sheets. Section 7. Measuring success. Key financial ratios for business health. In the world of business, numbers tell a story, but sometimes you need to dig a little deeper to understand what those numbers are really saying. That's where financial ratios come in. These powerful tools help you analyze your business's financial health and performance. One of the most important financial ratios is profit margin. This ratio measures your profitability by showing how much profit you make for every dollar of revenue. A high profit margin indicates strong financial health and efficiency. Another key ratio is return on equity, which measures how effectively you're using shareholder investments to generate profits. The debt-to-equity ratio is another important metric that measures your business's leverage. It tells you how much debt you're using to finance your assets compared to equity. A high debt-to-equity ratio can indicate financial risk. By analyzing these and other key financial ratios, you can gain a deeper understanding of your business's strengths, weaknesses, and areas for improvement. Remember, financial ratios are more than just numbers. They are valuable tools for making informed business decisions and driving financial success. Section 8. Predicting the future. Using ratios to anticipate performance. Financial ratios are like looking in a rearview mirror. They tell you where you've been and how well you've performed in the past. But what about the future? Can financial ratios help you predict how your business will perform down the road? The answer is yes, to a certain extent. By tracking financial ratios over time, you can identify trends and patterns that may indicate future performance. For example, if your profit margin has been steadily increasing over the past few years, it could be a sign of continued growth and profitability. However, it's important to remember that financial ratios are just one piece of the puzzle. Other factors such as market conditions, competition, and economic trends can also impact your business's future performance. Use financial ratios as a starting point for your analysis, but don't rely on them solely. By combining financial ratio analysis with other forecasting methods and a healthy dose of common sense, you can make more informed decisions about the future of your business. Remember, the goal is not to predict the future with certainty, but to make the most informed decisions possible based on the information available. Section 9. The Money Masters, the Federal Reserve and its impact. In the United States, the Federal Reserve, often referred to as the Fed, plays a crucial role in shaping the economy. This powerful institution acts as the central bank, responsible for maintaining a stable financial system and promoting economic growth. But how exactly does the Fed do this? One of the Fed's primary tools is monetary policy. By influencing interest rates and the money supply, the Fed can encourage or discourage borrowing and spending. Lowering interest rates makes it cheaper to borrow money, stimulating economic activity. Raising rates, on the other hand, can help curb inflation. The Fed also supervises and regulates financial institutions, ensuring the safety and soundness of the banking system. It acts as a lender of last resort, providing emergency loans to banks facing financial difficulties. Understanding the Fed's role is crucial for anyone involved in business and finance. Its decisions on interest rates, inflation, and financial regulation have a ripple effect throughout the economy, impacting everything from borrowing costs to investment decisions. Section 10. Money in Motion, exploring different financial institutions. Financial institutions are the lifeblood of the economy, facilitating the flow of money and credit between savers and borrowers. These institutions come in various forms, each playing a unique role in the financial system. Commercial banks are the most familiar type, providing checking and savings accounts, loans, and other financial services to individuals and businesses. Investment banks, on the other hand, focus on underwriting securities, facilitating mergers and acquisitions, and providing financial advice to corporations and governments. Credit unions are member-owned financial cooperatives that offer similar services to banks, but often with a more community-focused approach. Insurance companies provide financial protection against risk, while mutual funds and pension funds pool money from multiple investors to invest in a diversified portfolio of assets. Understanding the different types of financial institutions and their functions is essential for navigating the complex world of finance. Whether you're opening a bank account, investing for retirement, or securing a loan, knowing where to turn and what to expect can make all the difference. Section 11. Lessons from the brink. Understanding the 2008 financial crisis. The 2008 financial crisis stands as a stark reminder of the interconnectedness of the global financial system and the devastating consequences of unchecked risk-taking. A complex interplay of factors contributed to this crisis, which led to the worst economic downturn since the Great Depression. One of the primary triggers was the bursting of the U.S. housing bubble. Years of loose lending standards and speculation led to a surge in home prices, fueled by subprime mortgages offered to borrowers with poor credit. As housing prices began to fall, defaults on these risky mortgages skyrocketed. This triggered a chain reaction throughout the financial system. Banks and other financial institutions, heavily invested in mortgage-backed securities, faced massive losses. Credit markets froze as fear and uncertainty gripped investors. The crisis spread rapidly from Wall Street to Main Street, leading to widespread job losses, business failures, and a sharp decline in economic activity. The 2008 financial crisis serves as a cautionary tale, highlighting the importance of financial regulation, risk management, and ethical behavior in the financial industry. It underscores the need for greater transparency, accountability, and a deeper understanding of systemic risk in an increasingly complex and interconnected global economy. Section 12. Time is money, the power of compound interest. In the world of finance, time literally is money. This concept is best illustrated by the power of compound interest, often called the eighth wonder of the world. Compound interest is the snowball effect of earning interest on your initial investment plus any accumulated interest. In simple terms, it means your money earns money, and then that money earns more money, and so on. The longer your money compounds, the more powerful the effect becomes. Let's say you invest $10,000 at a 5% annual interest rate compounded annually. After the first year, you'll earn $500 in interest. But here's where the magic happens. In the second year, you earn interest on your original $10,000 plus the $500 in interest, for a total of $10,500 earning interest. As this process continues year after year, your money grows exponentially. This highlights the importance of starting early when it comes to saving and investing. The earlier you begin, the more time your money has to compound and grow. Compound interest is a powerful force that can help you build wealth over time.